Welcome to today's Explainer. We're diving straight into the fascinating evolution of B-class development banks in Nepal. We're going to transform those structured study notes into a clear visual journey. And since we're really focusing on the key milestones in Nepalese banking today, if you're tracking how this financial ecosystem was built from the ground up, you are in the exact right place. Here's our agenda for today. We'll start with the anatomy of a development bank. Hit those key historical milestones, look at capital tiers and working areas, cover their core functions, compare them to commercial banks, and finish up with the modern landscape. Starting off with Section 1, the anatomy of a development bank. Okay, let's look at this legal definition from BAFIA 2073. We're talking about NRB-licensed B-class financial institutions. But here's the kicker. They aren't built for your everyday nationwide retail banking. They're specifically targeted at regional and sectoral development through medium to long-term credit. So it's a completely different structural intent right from the start. This brings us to a really brilliant concept known as patient capital. It's exactly what it sounds like. We're talking about investing in agriculture, tourism, hydropower, and SMEs. The returns, yeah, they're pretty slow, but the social benefit is absolutely massive. It's essentially the exact same logic that created the World Bank globally, just zoomed in and scaled down for Nepal. Moving right into Section 2, historical milestones in Nepalese banking. This graphic maps out the entire journey. You can literally see the timeline from the first dedicated laws back in the mid-90s, all the way through to the massive consolidation era we've seen recently. It's a real roller coaster of birth, rapid growth, and then a strategic shrinking of the sector. Let's actually break down these key milestones, especially if you're tracking the dates for an exam. It all kicked off with the Development Bank Act of 1995/96, or 2052 BS. Then the very first one, Nepal Development Bank, hit the ground running in 1999. Fast forward to 2008, and NMB Bank Nepal made huge waves by merging and upgrading to an A-class bank. But honestly, the absolute game changer was in 2015/16. The Nepal Rashtra Bank dropped a strict capital raising policy that triggered mass consolidation. It literally forced dozens of banks to either merge or shut down completely. That brings us to Section 3, capital tiers and working areas. 2.5 billion rupees. I want you to lock this number in your head. Right now, this is the minimum paid-up capital you need to operate a national-level development bank in Nepal. It's a massive financial threshold put in place to guarantee stability and capacity across the entire country. But, it's not a one-size-fits-all situation. The required capital depends entirely on your working area. National level is 2.5 billion, sure. But step down to the provincial level and it's 1.2 billion. District level for 1 to 3 districts, 500 million. And crucially, no matter the tier, they have to maintain strict Basel III aligned buffers. We're talking a minimum 6% core capital, or Tier 1 ratio, and a 10% total capital adequacy ratio. Why do this? Simple. To protect depositors and keep systemic risk out of the economy. All right, Section 4, core functions and economic role. This flowchart from our source does a brilliant job of breaking their operations into 3 distinct buckets. On the left, we've got primary functions. In the middle, sector-focused financing. And on the right, general banking services. It's a perfectly organized structure balancing everyday banking with that long-term economic mission. So let's unpack those buckets. Their primary gig involves accepting deposits and handing out medium to long-term project loans. Sector-focused means they are the ones really driving money into agriculture, tourism, and cottage industries, literally the lifeblood of Nepal. But on the general side, they're still doing remittances, cards, mobile banking, the usual stuff. The real takeaway here, though, is their unique economic role. They promote regional economic development by stepping into semi-urban and rural areas where traditional commercial banks usually wouldn't tread. Which leads perfectly into Section 5, commercial versus development banks. If you're trying to build a mental map for an exam, this table hits the nail on the head. Look at the minimum capital A-class commercial banks need. A whopping 8 billion rupees right out of the gate for nationwide retail. B-class development banks scale from 500 million up to 2.5 billion based on their region. And check out the count for 2026, we're looking at 20 A-class banks and just 17 B-class banks remaining. To put it in the simplest terms possible, commercial banks are built for speed and full-service retail. They thrive on short-term commercial credit. Development banks, by their very design, are built for endurance. They focus heavily on that medium to long-term regional and sector-specific project financing. Finally, let's look at Section 6, the modern banking landscape. 17. That is the magic number today. Only 17 development banks remain licensed in Nepal. Think back to those historical milestones we talked about earlier. This is a dramatic drop from the dozens and dozens that were operating before the Nepal Rastra Bank pushed that massive consolidation back in 2015 and 2016. And among these surviving 17, we have some absolute heavyweights. Muktinath Bikas Bank is the largest by assets, sitting on roughly 132 ARBA. You've also got top-tier Kathmandu-based players like Garima and Jyoti Bikas banks. And outside the capital, Shine Rasunga out in Butwal is a highly notable player. But here's the current trend you absolutely need to take away from this. The lines between A and B class services are completely blurring right now. These national-level development banks are directly competing with commercial banks for the exact same customers. So I want to leave you with this final burning question to think about. As these lines continue to blur and capital requirements keep forcing consolidation, will B-class development banks eventually disappear completely, merging entirely into the commercial A-class? Or is there still a vital, irreplaceable need for them to reclaim their origins and provide that patient capital to the regions that need it most? It's something everyone following finance should be watching closely. Thanks for hanging out with me for this explainer, and keep learning.